Good afternoon, ladies and gentlemen, and welcome to the MJ Hudson Group PLC investor presentation and Q&A. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted anytime via the Q&A tab situated on the right-hand corner of your screen. Simply type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard, and you'll be notified once they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Matthew Hudson, CEO, Odi Lahav, COO, Peter Connell, CFO, and Andrew Walsh, Director of Corporate Development. Good afternoon.
Hello, good afternoon, everybody. This is Matthew Hudson. Thanks for joining. It's all very exciting. We've not done one of these before, so if we make those mistakes, hopefully you'll forgive us. I'm sorry you can't see my face, but like many people during lockdown, I've got local broadband issues. Anyway, here I am. So on page 2 of the slides, which is headed "What We Do," just to remind you all, we IPO'd at the end of 2019 on the day of the general election. So we managed to hedge the Boris Corbyn result by about 7 hours, which wasn't actually a deliberate strategy, but they seem to follow our timetable on the general election. And then within 2 or 3 months of IPO, we then hit a lockdown. And so we've been actually most of our time as a listed company in some sort of lockdown. But despite that, we're on track, and we've been doing what we said we'd do on the IPO and hitting our profit numbers. So on page 2, what we do. So we work in the alternative fund management industry, which essentially means in terms of our client base that they are either managers or institutional investors, meaning pension plans and similar, who are involved in alternative asset funds, by which we mean private equity, private debt, venture capital, real estate, infrastructure, and renewables, and a small amount of hedge fund work, but we're not that hedge fund focused. Next page, Andrew, page 3. So in terms of our geographical spread, you can see we're focused in North Europe and North America. About 80% of global assets under management in the private fund or alternatives world is in North Europe and North America. We don't have an office in each one of these places, by the way. Just particularly in this new world in which we inhabit, we have teams, some of which we have offices. Our main office is in London, where the 4 of us are based. And we have, if you look at the box below, we have about 230 specialists in our company in North America and North Europe. Next page. So this is the page with ships on it. So just this kind of graphically sets out what we do for a living. So the industry which we service is the asset management industry is $100 trillion kind of plus. So it's a big market. But if you look at actually what we do, we set out this page to represent it. So we help designing. You look at number 1 on this page. We help design and build investment funds. And in this story, they're boats. So we help build these things. We have a division. We have 3 divisions. Our first division is what we call advisory, where we work with the sea captains or fund managers who come to us and say, "Ahoy, we want to build a boat." We also work with pension plans and asset owners who provide the money to build and sail this boat as well. So we work with very much on the design side, building these boats. The boat then number 2, boat launches. And essentially the journey of a private fund or an alternative asset fund is about 15 years on average. And we work nearly entirely in the close-ended, not only, but mostly in the close-ended funds, which means they have a fixed life. But we also do a little bit of work on the open-ended side. So the boat starts sailing, and obviously it's been built, and it's been built to trade. And so we designed it, but then in addition, in our second of our 3 divisions, which we call outsourcing, we also provide the sailors and the engine, if it has an engine, although because we have a significant ESG component of what we do now, we try to do sales or make the engine electric. So we provide in our outsourcing division the crew to take this ship around its 15-year journey. The sea captain jumps on board. He's the fund manager. It is and her job to trade the gold. They then trade the gold during 15 years, and we stay with the boat during this journey. And then the boat comes back to its origin, port of origin, where hopefully they've turned every single gold doubloon into 2 gold doubloons, and they've turned the money to the investors. In the second half of the journey, once we started to make investments, this is where our third of our 3 divisions comes in. Odie's going to talk about the divisions in a bit more detail, but the third of our divisions comes in, which is data and analytics. We have a huge amount of data on all the ships or funds, so we can analyze them in depth around performance and costs, and increasingly matters like ESG performance as well. In terms of the industry, there are approximately 100,000 fund managers in North Europe and North America in our space, and there's about 200,000 asset owners, pension plans, sovereign wealth funds, family offices who invest in these funds. So the client universe is about 300,000. We represent about 1,200. So we're diversified in terms of a number of different types of clients. Not one of our clients represents a significant part of our revenue. But having said that, you can see the size of the market, 1,200 versus 300,000, the size of the market we have in front of us. In terms of the number of funds out there, our reckoning, our data shows us that each of these 100,000 managers has an average about 5 funds at any time out sailing the ships, sailing the seas and trading. So there's about 500,000 of these alternative asset funds out there. So it gives you the sense of size of the market. And also this slide shows you that we're involved all the way through the journey from the very beginning to the end. And also because we design the funds as well as help operate the funds, and thirdly, provide analytical tools in the fund's performance, we have a very large data set and a huge amount of knowledge, which differentiates us from our competitors because we both design and we analyze, as opposed to some of our competitors just operate. Next slide, page 5. So these are just a load of numbers. So we're 11 years old. I started the business on my own from scratch in the credit crisis in 2010. And essentially the reason we started it was because banks are blowing up, casino banking and all that. And so the teams of asset managers are spinning out of banks or being spat out of banks. And they needed a lot of help to support them, because although they're good investment professionals, they didn't have the mid and back office, they didn't have the design, they certainly didn't have the analytics. So that was the original thesis. And we still work on spin-out teams now and startups, but essentially because we've built this end-to-end toolkit, we get the very biggest managers now approach us to use a piece of our toolkit, essentially the bits they haven't got or the bits they need to help in, or the specialities they don't have, or they just want to outsource because there's a cost. As their management fees come under pressure, there's more of a pressure to outsource. So we're 11 years old, 11 locations, around 230 staff, 1,200 clients, as I mentioned. Over 200 of those are US based, and the rest are European. We IPO'd, going back to that day of the general election, we IPO'd not as an exit. We've not been private equity owned, although we've had a number of approaches. But really, we IPO'd because stock market website said that it provides capital to growth companies. So I thought, hey, that's we're one of those. So we raised capital to grow. We've been growing organically for most of our life, but we started making acquisitions to accelerate the growth because of the size of the market about 2 years before the IPO. And so we've invested the money since the IPO, making 4 acquisitions. And we just mentioned at the end, because it's quite interesting, that of our pension fund and some of our prime manager clients, 18 are in the FTSE 100. Page 6, these are just a bunch of logos. I won't go through them, but you might recognize names there of some of our clients. You'll see that essentially they're either very small or very big, which goes to that point what I said earlier. enough, the middle ground of fund management generally try to do everything in-house, but the little guys need loads of help, and the big guys need specialist help, and also very happy to outsource, or certainly happy to be analysed. Page 7, this is our mugshots. You can't see me, but that's me down the left, handsome gentleman. I've spent 33 years, I'm sad to say, working in alternative asset management, so I don't know anything else. And I'm a funds lawyer by background, and I built the biggest team in Europe focusing on funds as a lawyer. And then I've also worked in fund management. So actually, I worked in an incubator at Credit Suisse where we looked after fund managers in the late 90s, and this is where I learned a lot of my tricks now. I'm going to hand the floor now to Odie, who's the COO.
Thank you, Matthew. I guess I'll do a little bit of my background, then I'll jump into the next slide and talk about the more interesting content. I came in through one of the acquisitions that MJ Hudson made, one of the early ones, which was the old Allenbridge business, which was an investment consulting business focused on pension funds primarily, but with a bias towards alternative investments. And that was a business that I'd formed and run about 4.5 years before, when I spun out of Moody's, the rating agency. And when I was at Moody's, I was responsible for running the alternative investment group, initially in London, and subsequently also the North American business. And then spun the business out. Moody's took a stake in the then Allenbridge business, and that's what we later on merged into MJ Hudson. Aside from that, I've had several roles as an investment consultant. I worked at the Canadian regulator as well, focused on investment risk in conglomerate insurance companies, and I am an actuary by training. If I go on to the next slide, so Matthew already talked about this. This is kind of the twin, slightly less creative version of the ships slide that Matthew walked you through. So it explains how we structure the 3 divisions within MJ Hudson to accomplish that whole journey that Matthew outlined through the ships, and talks a little bit about each of the business models. So I'll just take them one at a time. The advisory business, which was kind of the original business, the law firm and the investment consulting, is the design and build model that we have. It is the law firm, as Matthew mentions, focused on funds, and the investment advisory business focused on institutional investors and kind of designing and building portfolios for them, with the majority of the clients being pension funds, charities, family offices, etc. I think what's important in this business, and it's important to note, is that although it is an advisory business, it is very much dependent on people. And isn't really a big recurring revenue type of business, which I know is what we all kind of hope for in a listed company. What we do have is a high level of repeat rate in the business. So when we work with a private equity fund, we will likely continue to work with them for that 15-year journey that Matthew talked about. If we have helped them launch Fund 1, we will likely launch Fund 2, Fund 3, Fund 4. And when we look at the analysis that we've done on those types of clients, we typically have an 88 to 85% repeat rate if we've worked with one client before to get that same client again from one year to the next. And then the investment consulting business is where we have our longest term contracts, which again, although are not recurring per se, but we could sign 3 or 5 year contracts. We work a lot with local government pension schemes in the UK, and that's how they generally tend to operate on the consulting side. The second division, which we call outsourcing, is really, if you want to think of it as asset management infrastructure. So this supports asset managers and investors. We have regulatory services in there. We have fund administration services in there. We have corporate services in there. And again, a lot of the business in there is kind of very sticky revenue, recurring business. And the idea, basically, a one-stop shop, come in and we can help you run your fund, as it were. And the last one is the data and analytics division, where really our goal is, it's focused on 3 things. It's data, which is effectively, what do I need if I'm a client? How do I source it? Put it all in one place. So we collect data to help our clients. We process the data. So we do an analysis. We process the data. What does it mean? What are the key messages to take out of it? And we help clients with reporting. So what do I need if I'm the client? What does the regulator need? What do other stakeholders, maybe investors, what do they need? And we do this basically looking at 4 different things. It's performance, of course, that's a key thing for investments. It's risk, how much risk am I taking? It's ESG and sustainability, which has become ever more important in the world we live in today. And we've got a slide specifically on that, so we'll talk a little bit about that on its own. And then it's benchmarking. So how is my service provided, or how am I doing versus other players? And that's how that business is designed. And it's a combination of a subscription style business and a little bit of consulting on the side. So you analyze the work, and then you help people solve problems, or you help people solve a problem, and then you help them with reporting. And the last thing, which I think important to flag here, is that as we progress from left to right in the slide, we go from a people business to a process business in outsourcing, to more of a software business, which is in data and analytics. And the margins on that last line go up from roughly 20%, which is our target, to 30% and to 40+%. So if I go to the next slide, this slide is really important in context. And the context is that 4 or 5 years ago, all we were was an advisory business. And that was, at that time, the decision was made to try to build out a platform. And as you can see, kind of roll the clock forward 5 years, and we've transformed the business into a far more balanced business model, where less than half of the revenues are in the more mature advisory business, and outsourcing and data analytics have climbed up. And the difference in percentages between the bars and the pie chart is that margin impact that I talked about in the previous slide, to show that the more profitable businesses are in data and analytics and in outsourcing, and hence the profits are more evenly distributed. And lastly, the numbers on the right-hand side just illustrate the point that we are growing as an organization in a different way, and more of our staff are now not in the advisory business. And actually, these numbers don't include our latest acquisition, which was only consolidated in mid-February. And with those numbers, the outsourcing division is now bigger in terms of people than the advisory division. If I move on to the next slide, which summarizes the results, and Peter, the CFO, will do that in a second after introducing himself. But if I could just talk a minute about the markets, I think there's a very simple message, which runs through our business, which is, if the market is growing and there's lots of activity, that's good for us. And if regulation is on the uptrend, and again, there's lots of activity, lots of new regulation, that's also good for us. Why? Because our clients then need more help. Reporting changes, different measures come into force, and ESG is a prime example of that, where the rules keep changing and getting more and more complicated. It's good for us. It's good for our business, and it helps drive the business forward. And pleased to say that sitting here now, a year from the first lockdown, our market is growing in alternative investments and recovering, and that's driven largely by the shift of institutional investors away from traditional risk assets more into alternatives, and the good performance that alternatives have shown over the years. And again, it's a bit of a mixed bag. Not all alternatives are the same. Some are doing better than others, but we cater to a broad spectrum. So our business model allows us to basically scale up into the different asset classes that are popular at a particular point in time. And with the slight pause that we saw in the first half of our financial year, so in the 6 months to the end of December, which resulted from lockdown and COVID, and we saw a bit of a sluggishness in the advisory business, we are starting to see that thaw, and we're seeing activity levels come up. And that's both on the fund launches side, but also when it comes to mergers and acquisitions and that kind of transaction volume, which is good for our business. And regulation is still on the upswing ever since the global financial crisis. it hasn't really paused in Europe, and in the US it's kind of gone through a bit of a cycle, but again it's back on the upswing. And with that, I'll hand over to Peter. Peter.
Thank you, Odie. Yeah, good afternoon, everyone. This is Peter, the CFO. Yeah, my background, I joined Matthew in the beginning of 2014. I originally trained as an accountant with KPMG many years ago, and then spent 20 years plus in the insurance sector. The most relevant for the role I have at the moment, I joined the Hastings Direct business as the founding FD in 1996 and saw that through its first 10 years of sort of high growth, and that culminated in a trade sale to Insurance Australia Group in 2006. Subsequently, that group's gone on and is now listed. I left after an integration with another acquisition that they made and spent a few years as a FD at a large regional law firm, and then the opportunity to come and work with Matthew appeared, and very much I see that as a combination of that first 10 years at Hastings Direct, which has been underpinned by my time as a law firm FD as well. So back to the slides, just on, I'll talk about organic revenue in a bit more detail on the next slide, but you can see we're now back up to positive, having been negative in the previous 6 months. So we're back into positive territory in December. The advisory division, as Odie mentioned just now, we're seeing good momentum now, and that's flowing through. Outsourcing side, again, we're seeing good performance there coming through in the first 3 months of this calendar year as well. Star performer in terms of organic terms has been our ESG business, which there's a slide a little bit later on that Odie will talk you through. We've seen 83% organic growth in that area in the last 6 months. I'll just explain briefly about organic investments. Where we don't find an opportunity to acquire, and there is either a jurisdictional or a product offering that we want to make, then we're quite willing to set businesses up from scratch. So we set up a Luxembourg fund management platform in 2017 after the Brexit referendum, so that we had cover within the EU. That business trod water for a couple of years, but is now going really strongly. And secondly, in regulatory consulting, again, we couldn't find anything to buy where the multiples were attractive to us, so we set that up from scratch with a new hire last year. And as Odie mentioned, the regulatory burden is only going in one direction, and that's increasing, so that team's extremely busy and going well. We've had some significant client wins in ESG in Luxembourg in the period. We'll talk about M&A on the next few slides. Just a couple of other things to mention on this slide. We're on the point of signing a senior debt facility, which there should be more news on in the coming weeks, which will be in line with sort of market expectations of debt levels. It's an M&A facility, but also we have an increased regulatory capital need as well with our Irish acquisition, which we'll talk about in a moment. We've also confirmed that we intend to pay our maiden dividend in respect of the current 6 months, so the 6 months to June 21. There'll be more on that as well in our full year updates as we go through. On the next slide, over.
Yeah, Odie's going to pick up this slide on the acquisitions.
Just quickly on organic growth, you can see, we look at the dark bars on the chart, you can see we've gone, these are all percentages, we've gone 12.5% in the 6 months to December 20, negative 4.5% in the 6 months to June 20, back into positive territory at 3.6 here, and we're expecting the second half of 21 to get back into line with the two bars on the left that you can see there in terms of the performance for the 6 months. And then I'll hand off to Odie now to talk about M&A.
Thank you, Peter. So this slide shows you a little bit about our M&A activity since 2018, and shows what we talked about a little bit earlier when we said that we were shifting from a business that was focused entirely on the advisory side of things, and shifted into outsourcing and data and analytics. So completely in line with the strategy. And to Matthew's point around where is our market, which is North America and Northern Europe, our acquisitions have been in line with that. It shows the transitions. The latest one, which is Perax, which has only just started, or I guess kind of going through its integration, is a performance analytics tool, and we can talk a little bit about that. I think there's some questions in the Q&A already, so we'll talk a bit about our performance analytics a bit later. And then I think there's one important point here. So the Bridge Group acquisition that we list here in that kind of central column at the bottom, which is an Irish supermanco. So it's one of the regulatory platforms we have in Dublin, which is a major fund center in Europe, which is a nice and kind of important building block for us in terms of the build out of our regulatory platforms. And completed the set of the main fund centres across Europe that we now have in terms of Luxembourg, London, Channel Islands, and Dublin. That business has closed in October 2020. In fact, it's only just gotten the approval from the Central Bank of Ireland about 6 weeks ago. So only from mid-February have we actually started integrating this business into the numbers, and so you'll see that starting to come through the numbers for the second half of this financial year for us. And then lastly, I mentioned a bit earlier the people aspect of this, which is you can see at the bottom, 75 people in the advisory division, 81 in outsourcing. So outsourcing with Bridge is now bigger than advisory. And then another important point is that data and analytics division by its nature relies quite a lot on our technology group, which is a central resource function. So although that says 50 people, we've also spent the last couple of years really scaling out our proposition in technology in general and building out our application development capabilities. And so there's this, that number is actually bigger, and we've now got a double-digit people who are in application development and building out systems and infrastructure. If I go to the next slide, so we talk about ESG and sustainability, and this for us at the moment is an absolutely huge opportunity. The market is growing exponentially and is only accelerating from one quarter to the next. To Peter's point, we're seeing substantial growth rates. 83% in 6 months, but more importantly, we're seeing double-digit growth rates quarter on quarter, and it doesn't seem to be letting up. We're getting inbound inquiries, kind of organic growth, traditional private equity type of work that we're doing from existing clients, from new clients across Europe, where this has been fairly well developed. ESG is a couple steps ahead of North America, but we are seeing the United States now also start to pick up, and we're having conversations with large and small investors across the board. We're seeing, although we are known in the space more for being private equity focused, we're seeing non-private equity alternatives also coming through to us. Investors such as large pension funds, including some of the local government pension schemes that we work with, wealth management firms, and lastly, we've even started working with AIM companies where they have a challenge. Both investors, so the fund managers, as well as the companies themselves, have a challenge with data collection and being able to have sensible evaluations given the size of the company. And because we tackle things from even a smaller company, which is more like private equity owned, we come at things from the bottom up rather than the top down of some of the other providers. So we're seeing huge potential opportunities there, and we also think it's just the beginning. That social and regulatory catalyst point, second point, is really important. The social one, I think we all see and live with all the time. Regulatory is only really just kicked off. The rules around for pension funds, the rules for financial services companies are all really in there, still being developed and rolled out. And then you have rules that are specific to ESG and climate change, which are already in the pipeline. And we expect that to continue to drive business in our direction, and more generally to drive asset managers and investors to embrace ESG and sustainability more and more. And those are the things like the SFDR rules in Europe, the EU taxonomy, also coming through in Europe, all of which have only really just begun to bite, as it were. We are very well positioned. We started this a bit earlier than most, not as early as some, but a bit earlier than most, particularly in alternatives. We co-wrote and championed ESG for private equity, working with the United Nations PRI in 2018. Our current ESG business was bought through an acquisition of an Amsterdam-based consultancy and reporting business, which we did in July 2019. And that business we've more than doubled the size of the team since then, and actually even in the last 6 months, it's been a growth of 15%, and that excludes the amount of staff and resources that we're focused in the technology space in ESG. What do we do? Haven't covered that yet. So we provide services to investors and asset managers as typical, and now we cover companies, as I mentioned. We do, as per the strategy for data analytics, we do data capture. So we help people collect data and basically ensure that they have the right data in ESG, and we try to be framework agnostic in that, which means that if we help you collect the data, you should be able to answer any due diligence questions from investors that you might get. We analyze the data, so we help evaluate it and how it's doing, and we do reporting on that data as well. And this is both regulatory reporting, but also reporting for other stakeholders like investors or senior management for that matter. And then lastly, we've been spending quite a lot of time lately positioning ourselves for the growth to come in the sector, and that is included quite a lot of time and effort spent on building out the right kind of system, so that a technology platform that can help us not only scale this business, but can also help our clients become more effective. And we've expanded the product suite to allow for data collection frameworks to be delivered through a system, to have self-assessment modules, carbon footprint estimation, customized dashboards for clients, things of that nature. And that system is being rolled out in the next few weeks. And we've already won a fairly significant mandate with a large international financial services firm that, well, I say we've won it. We haven't signed it yet, but we are fairly confident that it's going to get signed very, very soon. So all of that is very exciting news, and it's an area which we're very enthusiastic about, and we think it's going to be a source of growth for this business for quite some time. If I go to what is our kind of summary in pictorially of why we think there's a tremendous amount of opportunities for us as a firm to grow. Again, we've got a proven track record as a management team of creating organic growth in the businesses. As I mentioned, our market is very active and growing and expected to continue. The catalyst of regulation is again expected to continue, and all of that is yielding quite a lot of opportunity for us to grow organic revenues. M&A, we've shown an ability to tackle this market, and we've built out our service offering, we've built out the platform, and so we have a proven track record of doing that. Peter talked a little bit about the organic investments that we've made, where we can't find the business we want to buy, we build it ourselves, and we've done that successfully in several areas, most notably the Luxembourg AFIM platform that we built. And then there's room for margin expansion, both as we embrace technology in the various areas. So when we build these platforms, we build them first for ourselves, and we are our own client in a lot of cases as well. And so that helps us improve our margins. And we're also, as we shift the platform from advisory more to operations and data and analytics, operational outsourcing and data analytics, the margin will naturally expand as well. And so we think all of those are strategically fit together quite nicely to facilitate our growth in the future. I think this one goes back to Peter or Matthew. I'm not sure.
It goes to Matthew.
Matthew.
Okay. So page 15, group operating outlook, or I'll do the first bit and then Peter can do the second bit of this slide. And by the way, everybody, you can judge by how long Odie took to present ESG. It kind of almost reflects the percentage of the time on this call, the percentage of our growth going forward. It's a very exciting opportunity for us. So in terms of looking forward, you can see in the first column what happened in the first half of this financial year to the end of December, and then you can see what we're looking at for the second half end of June. The absolute key point is the first one. which is that the advisory side, the launching of the ships, that slowed. Unless you're a really big name manager, you did not launch a fund during the lockdown of last year, or the lockdowns of last year. And this, by the way, I've seen about every 10 years in private funds. It happened in the credit crisis, where there's a kind of pause for about a year. It happened in the dot-com crisis, where there's a pause until George Bush invaded Iraq, if you remember that. And it happens, dare I say, in the kind of crazy Maggie Thatcher times as well, when there was a pretty rough year. So we've seen it again. But the good news is, for the second half of this financial year, we're now seeing that market open up, and now ships, we've been involved in the naval architects' room, sort of designing stuff. We're actually launching things now, which is good for us, because once we launch a fund, then we've got 15 years of growth off it. So that's a bigger change. Next bullet down, outsourcing also. Bear in mind, that's the sailors in my analogy. They're now happy because they're running up and down the sales. These new launch funds. The bridge acquisition is ahead of target, which is great. It's worth pointing out, by the way, that out of our roughly 250 staff before the Brexit referendum in 2016, we had nobody, zero staff in what's now the EU, whereas now we have 100. A bit sad, but say Britain being a Brit, but we've got now almost as many people in the EU as we have in the UK, which reflects our marketplace. Next point, continued adoption of ESG, lots of new rules, as already mentioned. We're integrating well the acquisitions, and we're winning big clients. Then the second bit of this slide 15, Peter.
Yes, certainly is. There's a question in the Q&A about what our forecast actually is for the full financial year. So just to explain there, we're looking at getting up to EBITDA of 5.7 million in June, and we're at 1.8 in December. So a lot of what we're talking about here is explaining how we expect to get from A to B within there. So in the first half, there was margin squeeze down to 15.8. Most of that was in the organic investments talked about before. We invested into Luxembourg, which is now seeing significant client wins in the second half revenue. So excluding that, the margins were just down by 1%, which was all pretty well driven off the back of the delayed fund launches that Matthew mentioned earlier. I talked about organic growth before. There are areas where we can and have cut costs. The organic investments are getting towards profitability now, and so in Luxembourg and regulatory consulting, pretty well there. And we're expecting high single-digit organic growth for the full year for the group, and confident of achieving that. And then 2 slides finally to wrap up with Matthew.
Just so page 16, summary, first bullet. Good progress in the first half, but it was tough. Let's face it, for a lot of people, including us, in terms of the funds or the ships not launching. But we've got a lot of visibility, to Peter's point earlier, about the rest of this financial year to the end of June, because we've designed the ships. It's just now we're launching them. So we can see we have confidence in the second half of this financial year. Second point, we have actually made a lot of investments. We've hired more people in technology, because obviously that's a pretty important part of the new world. We've hired people who frankly probably couldn't have hired in really big bull markets, because they just they want to work at JP Morgan or Clifford Chance or whosoever. But we've been able to, with the capital raised at IPO, been able to selectively hire, which is good for the future. Third bullet, we've integrated well. The businesses we buy, by the way, are typically not typically, they all are founder-owned. We've known them for a long time. They provide a service which we've already worked with quite a lot already. So frankly, it's been easier for us to integrate. And also, we're all in the same industry, so it's not like we're buying things. We're making cards and we buy an ice cream maker. We're buying things we understand and we work with. Next point, we've had some good milestone new client wins. The M&A opportunities, we've got a pipeline of M&A which we want to bolt in. But at the same time, we also, we're growing organically, and And the last point, as Peter mentioned, we've confirmed the dividend timetable, which is a fancy way of saying that we're accruing a dividend from 1 January this calendar year, and we'll have a progressive dividend policy. The first dividend will be small, but it will grow and grow, hopefully. I believe that's what progressive dividend policy means, I'm told by the stockbrokers, but that's our plan to grow it as the margins improve, as mentioned. Page 17, just to sum up the investment case. So point 1, we've got this exposure to alternatives. Ever since I've been involved in it for 33 years, the AUM in private funds, alternative asset classes has risen. The big ones right now, by the way, is private debt. There's such a thirst for yield right now. Private debt's very popular. Infrastructure is very popular as well. Again, it's partly because all the leaders are talking about digging all over the place. And again, there's a search for yield. And lastly, there's a big interest in renewables and sustainable funds as well. Point 2, so that's our biggest mover. The second big mover for us is number 2, which we've mentioned already, which is the more regulation and hassle there is, reporting, transparency, ESG, substance. It's all grist to our mill. Maybe a pain for our clients, but it is good for us because we provide the buckets and spades, in this with a kind of oily rag, as somebody told me last week. So we don't really mind whether the managers find gold in those distant lands, but because we're actually just charging them for running the ship. Point 3, we're an experienced team. We're also heavily invested. I'm the biggest shareholder in this group, and the management have all got shares and options, so we're heavily aligned with shareholders. Point 4, growth was not as good as we wanted it to be in the first half of this financial year, but we didn't know there was going to be a pandemic when we listed. But it seems to be recovering, and we're seeing a bit of a snapback, frankly, bounce back. The ships are launching. And point 5, we have a targeted M&A strategy to add more technology, build a bit more leverage in Europe, and particularly scale in North America. Our clients, as I mentioned earlier, they're all American, Canadian, or UK or European, North European. We have over a fifth of our clients are North American, and we want to scale more in North America, which is by far the biggest market, by the way. It's over half the market for us. So I'm going to end now. I probably have to do 40 minutes. I think we did it 41. So I think we're now into the Q&A session, aren't we?
Fantastic, Matthew. Perfect timing. Thank you very much indeed. And thank you to you and the team for the presentation. And ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated on the right-hand corner of the screen. But just while the company take a few moments to review those investor questions submitted already, I'd like to remind you that recording the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard on the Investor Meet Company platform. I'd also like to remind you that your feedback is important to the company, and immediately after the presentation has ended, you'll be redirected for the opportunity to provide your feedback in order that the company can better understand your views and expectations. Perhaps before we look at some of the questions submitted during the event today, we did have a couple of pre-submitted questions from investors, and Matthew, perhaps I can read the first one to you. What is it that makes alternative investments more interesting than other investments?
I think, I'll say this. I mean, they are largely uncorrelated to the mainstream asset classes. But the word alternative comes originally from pension plans. They would allocate money to investment, and then they'd have an alternative category. And so really alternatives is anything but mainstream equities, listed equities, and mainstream bonds. There's some fuzziness between the two, by the way, but essentially that's the difference. So what makes it attractive is that they're uncorrelated. That's the biggest point. Secondly, there's increasing retail interest in private assets, venture capital, even like developing properties. So there's also increased retail interest, and there's, as Odie mentioned earlier, because he's an actuary, so he would know this, wouldn't he? That there's a big thirst for yield right now, and a lot of our assets have yield, and I think also they're just I mean, private equity. There's deals every day. There's another announcement of private equity buying something. There's a hedge fund blowing up in America, as you probably read on Friday. which again sounds a bit mean, but it's actually quite good for us. These sort of, where there's friction and difficulty is good for us. So it's and last point I'd say is just frankly it's the only thing we understand. So that's what we do.
Can I add a perspective on for kind of pension funds, which I still work with a handful of those and some family offices and some charities. So they all work on long-term strategic asset allocation models, and with the fantastic gains that we've had in equity markets, particularly outside of the UK, but kind of global equity markets really since over the last 10 years. And the absolute almost zero return you get from investing in bonds today, they all have had to start looking elsewhere to make their investments. So Matthew's point on the non-correlation of the assets and the attractiveness of some of those asset classes to produce yield means that more and more investors are shifting more and more of their portfolios into alternative investments. And that market is enormous, and that's pension funds, sovereign wealth funds, insurance companies, all of the big institutional asset classes. And so that will drive alternative investments to continue to increase in size, which we're already seeing, and we'll see that continue based on the expectations of the market and certainly ours. And that's good for our platform, as we talked earlier. Sorry, Matthew. Just thought I'd add.
Fantastic.
Right, next question.
Thank you very much. The next question we've got here, and one you have covered quite extensively actually in the presentations. How's technology changing your business and your clients' businces?
You've got 70 seconds only to answer that.
Yeah, no problem. I'll make this one a quick one. Look, like everyone, operational, it's all about, for us internally, it's all about operational efficiency, right? So the same number of people can accomplish more if you have the right technology. So we are investing in the business. We are looking at embracing enterprise grade and tier one enterprise grade technology. And it kind of as we become a larger company, the economies of scale warrant that. And so we are looking at those where we can add them and where it makes sense for the business. And of course, this COVID-19 and working from home has just led everybody down a path and accelerated the move, where technology and communications become more and more important to ensure that you can continue to operate a business. And so, we're looking for that to break down silos, to facilitate communications internally. And that's how it works for us. Separately, as we build out systems, because as we talked about in data and analytics, our platform is about data analysis and reporting. That needs to include software development and technology. And oftentimes we build the systems for ourselves, we test them on ourselves, then we roll them out to clients. How does it help our clients? We collect data for clients, we help them aggregate it, we help them access it. We harness MJ Hudson's very wide breadth of data in alternatives, combination of risk, performance, ESG, legal information. It helps to create transparency. It helps to benchmark both as an asset manager and as an investor. In analytics, we analyze and provide insights to clients on those same things. So risk, performance, ESG, it helps our clients make better decisions, and it helps them explain their own offerings better to their clients. And reporting, it's kind of very simple. We either do the reporting for them, we do the reporting for their clients, or we do the reporting for other stakeholders like regulators. And that's how the client and ourselves benefit from the way we build out and use technology. That's it.
Early, thank you very much. Thank you, Matthew. Investors have submitted a number of questions during the presentation itself. And Andrew, perhaps if I could hand back to you just to run through the Q&A. May I ask just that you read out the question where it's appropriate to do so and just address it to who you think it would be best suited. Thank you.
Yeah, thank you for that. And also thank you to everybody for all the questions. And if we don't get through answering these questions in this call, I know everybody's got time constraints, then my details are on the website, and please do submit that and we'll try and answer afterwards. So the first question we have is from Sarah. The question is, do you use any software or consulting companies to analyze behavioral biases amongst asset managers when you review their performance? Which I think is a question for Odie.
Yeah, so we've got the Perax system which was the acquisition that I mentioned we made in December last year. We have some aspects of the analysis aimed at managers' biases, but we don't really have anything in particular that analyzes, specifically targets analyzing kind of behavioral finance type of biases. But as I said, within the Perax toolkit, we look at, the styles of the managers, the way they make money. The idea of the business is to try to understand how a private equity fund manager makes money, and that is not a trivial exercise, because there's a very distinct lack of data and a lack of transparency. And the data set that we have and the set of analytical tools that we've got, through the acquisition, which have been built by the founder of that business, Professor Oliver Gottschalk, who's still a professor at HEC University in Paris, but also works with us. It's designed to really help understand how managers have made money, either from the point of view of an investor or from the point of view of the manager themselves, trying to position themselves and sell it on. So aspects covered, but not in a direct way, Sarah. Andrew?
Thank you for your question. The next question is from Marzin. Can you discuss the quantum of deferred consideration outstanding and how you plan to fund this? And will funding this limit your ability to fund further acquisitions without resorting to equity? Good question, Marzin. Peter, can I pass that to you?
Yes, yeah, of course. Well, I think the first thing to say is that all of our the earn-out elements of consideration actually require transformative change actually in the businesses. So we're well aligned with the sellers in terms of wanting them actually to achieve this. If you take the bridge deal that we've done, the EBITDA there has to almost quadruple within a couple of years to get to the top of the earn-out targets there. And in the Perax deal that we closed in December, revenue needs to almost treble. So there is a significant degree of self-funding. In terms of our own discussions around borrowing, we're fully funded in terms of the acquisitions that have happened to date, and we've also been talking about some future M&A as well. So for what we have in immediate line of vision, we don't think we need to come back to the markets, but we are looking to scale up. So for larger M&A in the future, we certainly wouldn't rule out coming back to raising more equity.
Thank you for a question. Next question comes from Bill. How has Brexit affected your future growth prospects, and how important is it for MGH that the UK and EU get a speedy agreement on financial services? Very topical. I think that one I'm going to put to Matthew.
Yeah, sounds like one of mine. So I mentioned earlier that we had 0 people in the EU before the referendum, if you exclude the UK, and now we've got 100. So we have a lot of people in the EU, and in terms of our 4 main European fund platforms, which is UK, Channel Islands, Luxembourg, and Ireland, half of them are in the EU, which reflects our clients. Actually, I mean, our clients. We set up operations when they need them. So yeah, I mean, we sacrifice funds to fish, right? So the Brexit deal is not good for funds, but we have diversified, and we have now got these 2 major EU fund distribution centres in Luxembourg and Ireland, and thankfully, a lot of certainly private equity funds in the UK are now launching in Luxembourg, and a lot of hedge funds and more liquid funds are launching out of Dublin. So it's not been good for funds, Brexit, but we have diversified accordingly. The other thing which is good for us, I suppose, about Brexit and the equivalence deal you're referring to, Bill, that they got some new talk shop, right? But that's really all it is. But at least they're talking, I suppose, on the positive side. But in terms of equivalence, we're assuming there is never equivalence between the UK and the EU in financial services, or certainly in our world of private funds, maybe in the trading because it's more necessary. But it's certainly in the funds world, we assume there never is, which is why we built out in the EU. And again, it's sad to say, but the more hassle and difficulty, this is the second big driver of growth for us, is hassle. So the more regulation, the more hassle, the more annoyance, the more confusing, the more rules is good for us. So I'll be honest with you, I didn't like Brexit, but now we have it, and we've adopted it, we've embraced it, and we've assumed the worst from the very get-go.
Thank you for your question. I've got two questions which I think actually relate to each other, and the answer is similar. So I have Mazin asking, can you discuss the gaps between each division's actual margins and the targets, and how you plan to close that? And then Damien has asked, how do you expect revenue mix evolving across the three divisions over the next 2 and 5 years, and what's the long-term game roadmap for that? So Odie, you touched upon.
Do you mind? Sorry, Andy. Do you mind if I take the second question first and then hand to Peter on the first one?
Sure.
And that might be a Damien I know as well, maybe. So Dividend high. Yeah, I mean, we were 100% advisory when we first started, and now in terms of EBITDA, it's about a third. To launch a ship takes a year, but to sail a ship around the world and back again takes 15 years. So you can probably see the why outsourcing and analytics is becoming increasingly the bigger part of what we do. The good thing about analytics, by the way, the third division is it's software mass, so it doesn't have offices as such or regulation. So it's even got more operational leverage. It's also more about software development. We didn't have a software developer in the team 4 years ago. Now we've got, last count, sort of 7 or 8. So I think you're going to see, Damien, that the advisory will continue to shrink as a percentage of the whole, and analytics will grow, and the operations or outsourcing side will also continue to grow. I think if you take, say, 3 years in relation to your question, I think you'll see that outsourcing is about half the business, half the profitability, and then, sorry, 40%, apologies. And then analytics will be probably 45%, and then advisory, the rest side, not so much. But we don't want to lose the advisory side. The advisory is a trusted advisor. It understands the design of the ships. It's really important, and it's our differentiator from, say, like a SAN or JTC. It's our big differentiator. We design the things, we understand them, and when we operate them in our outsourcing side, we actually know why they're built the way they were built. So we know the front end from the back end of the ship. And then on the analytics side, again, it's quite a differentiator for us because we capture so much data in the market and provide these analytical tools, particularly ESG, as already mentioned at length. It is increasingly important for us as well. The other question, Peter?
Yes, yeah. In terms of the margins, the two areas that are lower than we're anticipating in the future, for order advisory and data analytics, two very different stories there. On advisory, really, it's all about the revenue picking up, and we've seen that coming through strongly in the first 3 months of this calendar year. When we have trimmed the teams through the COVID slowdown, but we haven't cut teams dramatically because we do see the revenue reduction last year as something that's deferred revenue rather than lost revenue. So we're well poised for that to improve quite dramatically in the second half. Data analytics, actually, the division didn't exist 3 years ago, so we made an acquisition in benchmarking called Amasees, which is a mature business. But the ESG only 18 months ago, high growth there. Margins are sort of running 10% higher this year than last year, and we talked about the organic growth coming through. That'll come through strongly in the second half. The Parax business is very exciting there as well, because that's something which is the processing of which is largely automated, so there's a high degree of operational leverage in there, and that will also help to get the advisory margins up to the area where Matthew was speaking to a moment ago.
Thanks for that. Can I go now to this question from Paul? It says the cash flow doesn't look strong enough to support dividend payments, and asks, is it wise to start paying dividends now? And I think that might be a question both for Matthew and for Peter. So can I go to Matthew first? Why do you think it's wise to start paying a dividend, and then go on to Peter?
Yeah, I think in terms of the wiseness or otherwise, I think it's a good discipline to pay a dividend. We are a growth company, but I still think it's a good discipline to pay a dividend, even if it's very small, and to gradually increase it. The company's owned by its shareholders as well as its staff and customers. And it sounds a little bit jealous thing to say, but actually I wouldn't mind dividend. I'm a big shareholder, and I think everybody else should get one. So I think it's a good discipline, but we're going to start very small. Peter?
Yes, I think that's right. In terms of the cash flow was positive in the first half. One of the things we did see with COVID was apparently the slowdown. So the pattern, say in law, from us beginning a piece of work to then being able to bill it and get paid was extended. And we're definitely seeing that snapping back now. So we're expecting sort of a very strong cash performance in the second half as well to underpin that. But as Matthew said, this won't be a massive start by any means. It will be a very small start. We're looking to build for this as a dividend that will just build over time.
Thank you for that. Marzin asks, how big were the ESG related revenues that grew 83% in the first half?
Yeah, I can take that one. In terms of the revenue for the first 6 months, it was just over $1 million at 1.1 compared to 0.6 the year before. We're tracking in line for something in the order of 2.6 upwards for the full year.
Thanks for that. Next question from Simon. Are your fees linked to fund size, growth, or performance? Can I give that first to Matthew and maybe for Odie as well?
Yeah, our fees aren't really based on their performance at all. So it's actually nothing. But they are based on the advisory side. They're not just based on projects. So it's not really size or definitely not performance because there's nothing to perform yet. The outsourcing side, yes, it is. This is where size comes in. It's a bits charge. It follows the management fee of the client. So if there's 100 million fund, then it's a certain number of bits. If there's $1 billion, it's actually a bit less. It's not. You don't follow it. It's not the same bits. Bits decline the bigger it becomes. But basically, the more bigger they are, the more the fees are, and they also have a minimum fee as well in the outsourcing. And analytics is not based on size. It's based on volume of data, which may be a function of size, by the way.
Yeah, and complexity is the only other thing I'd add. So if it's more complicated, typically it's a bit more expensive, but it's more subscription revenues, more of that kind of licensing type model.
So fundamentally, it's number of ships. But if they're slightly bigger ships, then it's a bit more fees, but definitely not based on performance. I mentioned earlier, if they don't find gold and get and they get like my forebear get marooned in some big bay in Canada, then it doesn't bother us because we just sail the thing back home without the captain.
Thank you for that. Marzin asks, do you have a view on the share price weakness? Is there an overhang? I might take the first part of that myself, actually, and then maybe others can comment. We have one investor, Marzin, who is both a wealth manager and a long-term growth fund. And the wealth manager, over time, has reduced their holding down to practically zero, I think, if you look at the RNS statements. And that, obviously, over time, and perhaps over the pandemic period, has had an impact on share price. But I can tell you that from our perspective, that part of that investor has now sold down. I don't know if anybody else wants to add to that answer on the team.
Yeah, I just think we're ridiculously undervalued. But hey, all CEOs say that, right? I mean, we've done everything we said we would since the IPO. We've doubled our EBITDA. We've made 4 acquisitions like we said we would, and we get rewarded with a near 30% decline.
Okay.
Bracket not upset at all. Bracket.
Another question from Bill. How does your business differ from that of SARM? Do you regard them as a major competitor? And there's a sort of a general question also about competition.
Yeah, they are a major competitor on our outsourcing side. But the differentiator is that they don't design the ship. So they have to go to all the designers, which is the lawyers mostly, and accountants, I guess, to a certain extent, and pitch with all the other outsourcing players. We generally feed our own outsourcing side. So the design is a big differentiator. We're the trusted advisor of the fund, and often the law firm of the fund, so we stay on the ship for 15 years. And then the second big differentiator is the analytics, which again is a big differentiator. But where we're very similar with SARM is that we have the same sort of clients, very similar client base. And so there's a lot of parallels there. In terms of competition, then there are law firms, none of the listed ones, by the way. They're not in our space, but there are law firms. They're also big three actuarial consultancies. There are other big administrators like Northern Trust or Citco, or in the States, SEI, Tech, and S&C Global. And there are analytical players like Moody's Analytics and IT Market and Morningstar and Sustainalytics and even Bloomberg and the stock exchange you found loved, Refinitiv. But our differentiator against all of them is that we're an end-to-end platform, a vertically integrated business, just focused in one area. And it all fits together like one platform. We have these three divisions, but frankly, when we talk to clients, we don't talk about these three divisions. We talk about a platform. In some ways, they're like a private fund version of like an AJ Bell or Hargreaves Lansdown.
Andrew, I think you've actually pretty much covered off every question that's come through. Unless there's anything else you can say, I think that's pretty much it. And if that is the case, Matthew, perhaps I could just ask you just for a final few closing remarks before we redirect investors to give you some feedback.
I just want to say thanks for bearing with us during our inaugural version of one of these presentations. So hopefully we weren't too awful. And we're, as Andrew mentioned earlier, very happy to take further comments and increase correspondence communication. So nothing to say apart from thanks a lot for listening.
Fantastic. Thank you very much. And just for all those attending, all the questions submitted today will be reviewed by the company and we'll publish those back out where appropriate to do so. Thank you very much to the team for updating investors today. Could I please ask investors not to close the session, as you'll be automatically redirected for the opportunity to provide your feedback. If you've accessed this meeting from our website, the feedback page will appear in front of you. But if you've accessed the meeting via the link sent to you in the email, you'll simply be asked to log back in and give your feedback. It takes just a few moments and be greatly appreciated by the company. On behalf of the management team of MJ Hudson Group PLC, thank you very much for attending today's presentation. That concludes today's event. Thank you and good afternoon.